In the span of a single long weekend, silver did something it is not supposed to do: 63. That is a drop of more than 30%, not over months, not over weeks, but inside a window that felt like 48 hours if you were watching the tape. The kind of move traders whisper about as a once-in-a-decade event, the kind of move that turns confident leverage into forced selling. Fast. And here's the part that breaks the normal story. In the same moment the price was collapsing, the world did not suddenly stop needing silver. Electronics did not stop shipping. Solar supply chains did not quietly shut down. Jewelry demand did not vanish overnight. A market does not lose a third of its value in days because the periodic table changed. So what happened? They said this kind of break could never happen again. Not in a modern liquid futures market, not with better risk systems, not with decades of lessons baked into the rules. Yet it happened anyway. And when a market does the impossible, it is rarely the market speaking. It is the mechanism speaking. Because while most people were staring at the price, the institutions were staring at the plumbing: margin, liquidity, deliverability, inventory classifications, settlement incentives, the boring words that decide who gets to stay in the game when volatility hits. That is the message in silver's darkest hour. Price is not just discovery. Price is also enforcement. And when enforcement changes, the chart can fall off a cliff while the underlying world barely changes at all. Welcome to Signal Before Headlines, where we decode what matters before it becomes consensus. If you've been here a while, you know the routine. We follow the numbers, we follow the incentives, and we watch the places where official narratives collide with market reality. If that's the kind of analysis you value, stay close. And tell me in the comments where you're watching from, because this story is global. Now let's reconstruct the event with forensic detail. 50 an ounce, a level that rewired expectations. The move into that high was not calm, it was vertical, breathless, a climb that makes everyone feel late and makes every short position feel trapped. When silver goes parabolic, it does not do it politely. It does it by making time compress. The candle bodies widen, the spreads widen, the sense of safety disappears. Then the air pocket opened. 63. In practical terms, that means a market that was celebrating new highs on Monday was liquidating by Friday. That means stop orders that were meant as protection became gasoline. That means funds that were diversified discovered that in a liquidity event, everything becomes correlated. The abnormality wasn't only the size of the drop, it was the speed. Silver is volatile, yes, but this was not normal volatility. This was cascade volatility, where selling triggers margin calls trigger more selling, and the market becomes a machine that converts positions into cash regardless of price. And right there, a central mystery appears. If silver is collapsing because demand is disappearing, you should see loosening everywhere. You should see inventories balloon. You should see premiums fade. You should see physical supply feel abundant. But in the shadows of this price crash, the inventory ecosystem is telling a more complicated story. Start with the largest, most visible institutional warehouse most people never think about. The iShares Silver Trust, ticker SLV. 59 tons of silver. That is not an abstract number. That is a mountain of metal that exists, accounted for, sitting in the financial system as a vehicle for exposure. Now layer in London. 4 billion, roughly 927,254 bars. That's a massive stockpile. And yet, having a massive stockpile does not automatically mean having a massive deliverable float at the exact moment leverage is being unwound. Then layer in the futures, exchange itself. COMEX inventories are often discussed as if they are one pile, but they are not. Eligible metal meets specifications. Registered metal is the portion actually available for delivery against contracts. 67 million ounces, big number until you compare it to the size of paper exposure that can lean on it. Now bring in the accelerant, margins. In mid-January 2026, CME updated its precious metals margin methodology. In the notice that rippled through the trading community, COMEX 5000 silver futures initial margins were set at 9%. That sounds clinical, like a footnote, but margin is the lever that decides whether volatility is survivable or fatal. When margin requirements rise, the market does not politely adjust. It sheds positions. Here's where it gets interesting. A margin change does not need to be huge to change behavior. It simply needs to arrive at the wrong time when positioning is crowded and price is stretched. In that environment, even a small shift can tip the first domino. The event is, silver hit a record high, leverage accumulated, the market's risk controls tightened, and then the price decline turned into forced liquidation that fed on itself. If that sounds familiar, it should. Silver has a history of teaching the same lesson with different costumes. The hidden pattern is not the metal. It is the intersection of speculation, leverage, and rule enforcement. In 1980, silver became a cultural moment. Prices surged as the Hunt brothers and other participants accumulated massive positions, and the market became a symbol of inflation, fear, and financial rebellion. Then the rules changed. Margins rose. Trading restrictions tightened. The price collapsed. Result? A generation learned that when a market is too one-sided, the exchange can change the physics of the game. In 2011, silver surged again, feeding on post-crisis monetary anxiety and speculative momentum. It ran toward the high 40s, brushing the zone around $49. Then, once again, margin increases and risk constraints arrived into a crowded trade. The air came out fast. Result? The chart didn't just correct, it broke, and leveraged exposure discovered that a long-term thesis can be destroyed by short-term mechanics. In 2020, silver collapsed with everything else in the March liquidity shock. Not because silver became worthless, but because cash became king, forced selling hit across assets. Then, as the system stabilized, silver rebounded hard. Result? The move down was about liquidation, and the move up was about the absence of forced sellers plus renewed demand for monetary hedges. Now, in 2026, it's happening again. Not the same headlines, not the same characters, the same pattern. A sharp, compressed move into a top, a crowded narrative, a volatility shock, margin and risk controls tightening. And then a fast, brutal unwind that looks like the world changed, when in reality the rules and constraints changed. This is not opinion, this is pattern. Now let's talk about the players, because the players tell you what kind of move this was. First, the exchange. COMEX is where the price signal is broadcast. The price you see on a screen is heavily shaped by futures trading. Futures are powerful because they allow large exposure with limited capital through margin. That is not a secret. That is the design. But the design comes with a control panel, and that control panel is margins and risk methodology. When CME adjusts methodology or margin requirements, it is not announcing a prediction about price. It is responding to volatility and risk metrics. But the effect is the same. It changes the cost of holding a position. If you're long and leveraged, your cost can jump overnight. If you're short and leveraged, your cost can jump overnight. Either way, some players are forced to reduce. Second, the large funds and dealers that provide liquidity. When volatility spikes, market makers widen spreads. Dealers reduce inventory risk. Liquidity becomes conditional. That means orders move price more. That means stop-loss clusters get triggered. That means the fall accelerates. Third, the ETF ecosystem. SLV is not a tiny sideshow. 59 tons, it represents a channel that links investor flows to physical holdings. In times of stress, ETF flows can amplify narratives. If investors sell shares, authorized participants can redeem and metal can move. If investors buy, metal can be added. The point isn't that ETFs cause moves. The point is that they are part of the system's storage and transmission. Fourth, the London Vault Network. The end December 2025 number, 27,818 tons, tells you the system holds a lot of silver. But that system also has claims, leases, swaps, and industrial demand tied into it. Inventory exists, yet availability can still feel tight at the margin, especially when deliverable categories matter. Fifth, the regulators and policy signals in the background, not because of ideology, because policy affects rates, collateral, and the appetite for leverage. When money is tight, the system is less forgiving. When money is loose, the system can absorb shocks. Silver's 2026 drop happened in a world where liquidity sensitivity is high. Now connect the dots through timing. A record high on January 26th, a breakdown into January 30th, a margin methodology update in mid-January that signaled a more dynamic, risk-responsive environment. A huge institutional stockpile visible through SLV by February 2nd. A London Vault stockpile recorded at the end of December. A COMEX registered figure that looks large until you remember how many paper claims can sit on top. This is the coordination without a conspiracy. It is the coordination of incentives. Everyone is responding to the same stress signals at roughly the same time, and the responses line up like gears. Now we reach the dislocation, the part most people miss, because it requires holding two contradictory truths at once. Truth one, the paper price can collapse violently because paper positioning is leveraged and margin sensitive. If leverage is forced out, price drops, regardless of long-term fundamentals. Truth two, physical stockpiles can remain large while deliverable or immediately available. Float feels constrained. Inventory numbers can be impressive, yet the market can still experience localized tightness, premiums, or delivery pressure, because not all inventory is the same thing. Let me make this simple with an analogy. Imagine a city with plenty of water in reservoirs. On paper, water supply is abundant. But if the pipes into a specific neighborhood are narrow and a sudden heat wave spikes demand, that neighborhood can still face low pressure and rationing. The reservoirs didn't disappear. The system's ability to deliver water where it's needed at the moment it's needed is what matters. Silver is similar. London's 27,018 tons is the reservoir. 59 tons is another reservoir. COMEX eligible stocks are water in storage. COMEX registered stocks are the water already connected to the delivery pipes. Now add leverage, which is like allowing households to consume water on credit, assuming it will be cheap later. When the city changes the rules and demands cash payment up front, a lot of households suddenly have to cut consumption immediately. That's forced selling in the financial version. The moment margins rise or methodology tightens, the market demands more collateral. Some participants can post it, others can't. The ones who can't become sellers, not because they changed their mind about silver, but because they ran out of balance sheet. Weakness in price can be a mirror of strength in enforcement. Now, let's walk through the evidence with numbers, because numbers tell you when you're dealing with mechanism rather than emotion. First, the move itself. 87 drop per ounce. Multiply that by just 5,000 ounces, the size of a standard COMEX silver futures contract, and you get a $184 or $350 swing per contract. That is a loss that triggers margin calls. Second, the margin context. An initial margin at 9% means the exchange requires a certain fraction of the contract's notional value as collateral. When volatility spikes, maintenance requirements can move and intraday margin calls can happen. The exact percentage matters less than the reality. Collateral needs rise when price movement rises, and that creates forced behavior. Third, the inventory structure. 67 million ounces sounds immense until you convert it into contracts. Divide by 5,000 ounces per contract, and that's about 134 contracts worth of registered supply if every ounce were delivered. Meanwhile, the open interest in the paper market can be far larger, and most participants never intend to take delivery. Fourth, the vault scale. 4 billion sounds like a fortress. But a fortress can still have gates. If metal is allocated to long-term holders, or tied up in industrial pipelines, or not economically mobile at current prices, then the amount that can respond quickly is smaller than the headline. Fifth, the ETF scale. 59 tons is a financial sponge. If flows reverse, it can become a source of metal. If flows surge, it can become a sink. Either way, it proves that institutional exposure is enormous, and that means the marginal decision makers are not only retail traders, they're funds, dealers, and asset allocators. So what does all of this mean? When a market collapses like this, the immediate temptation is to treat it as a verdict on the asset. But the inevitable outcome suggested by this pattern is different. It suggests that the market is flushing leverage and resetting the playing field. Historically, that process does two things. One, it transfers exposure from weak hands to strong balance sheets. The participants who can't meet margins sell to those who can. That is not morality, that is arithmetic. Two, it sets up a new range where price can once again reflect fundamentals, because the forced seller is gone. The market stops falling not when everyone feels optimistic, but when the sellers who must sell have finished selling. This is why silver's darkest hour comes with a message. The message is, watch the conditions that create forced selling, because forced selling is temporary and its footprints are visible. Now, forward analysis, without predictions, just pattern. If volatility remains elevated and risk controls continue to tighten, historically the first phase is continued instability. Bounces can be sharp, then rejected. Range expands, headlines swing. The market tests who is still overexposed. If volatility begins to compress and inventories remain steady, historically the second phase is stabilization. Price stops reacting to every rumor and starts reacting to actual flows. The chart begins to look less like a heartbeat and more like a market. If physical premiums rise while paper price remains depressed, historically the third phase is a relinking where the dislocation begins to close. That can happen through price rising, or through physical loosening, or through changes in contract structure and incentives. The gap cannot persist indefinitely, because persistent gaps create arbitrage pressure. So what indicators matter? Watch margin updates and methodology notices, because they tell you how the exchange is viewing risk. Watch volatility measures in the futures market, because volatility is the fuel for margin changes. Watch COMEX, registered inventories, not just total inventories, because registered is the deliverable category that matters under stress. Watch ETF holdings, because large changes signal institutional flow. Watch London Vault trends, because they show where metal is being stored and whether the reservoir is filling or draining. And there's one more number that helps you feel the dislocation in your bones. If you convert London's 2,718 tons into ounces, it's about 894 million ounces of silver sitting in those vaults, 59 tons, and you get about 532 million ounces. 43 billion ounces inside two highly visible systems, 67 million ounces in late January. In other words, the metal that is already tagged as deliverable against futures is only about 12% of London's reported vault total, and roughly 7.5% of London plus SLV combined. That doesn't mean disaster. It means the market is built like a pyramid of claims resting on a smaller foundation of immediately deliverable metal. This is how the storm spreads. A leveraged participant holds exposure through futures. Price drops. The broker demands variation margin, cash today, not a promise tomorrow. If the participant can't wire the cash, the position is reduced. That reduction becomes a market order in a thin moment. The market order pushes price lower. Lower price triggers more variation margin. More variation margin triggers more reduction. It's a feedback loop that turns a chart into a waterfall. At the same time, options dealers are hedging. When markets are calm, those hedges can be managed smoothly. When markets gap, dealers have to adjust quickly, buying or selling futures to stay neutral. That hedging flow can amplify the move, not because anyone is targeting silver, but because risk systems are trying to survive the speed of price changes. Then add the human element, managers, who are judged daily. They get a call asking why risk limits were breached. So even unleveraged funds can become sellers, not from margin calls, but from mandate calls. They reduce because they must. All of this creates a temporary distortion where the screen price is a liquidation price, not a clearing price. A clearing price is where willing buyers and willing sellers meet. A liquidation price is where forced sellers meet whoever still has cash and courage. That's why the snapback after liquidation can be so violent. Not because the world changed twice, but because the seller changed. So when you hear the phrase silver's darkest hour, don't interpret it as a prophecy. Interpret it as a stress test. It's the moment the market reveals where the leverage was hiding, where the liquidity was assumed, and where the inventory labels suddenly mattered more than the headlines. In moments like this, the loudest signal is not the headline candle, it's the behavior of collateral. When collateral is scarce, every dip becomes urgent. When collateral is abundant, dips become negotiable for all in the system. None of these indicators is a crystal ball, but together they tell you whether the move is still being driven by mechanics or whether a new fundamental narrative has taken control. And that brings us to the divide. They will see a chart, see a plunge, and conclude the story ends there. They will treat the price move as a moral judgment, as if markets reward and punish like characters in a movie. They will see the same chart and ask what had to happen behind the scenes for that plunge to be possible. They will focus on leverage, on collateral, on inventory classifications, on the quiet rule changes that turn a crowded trade into a stampede. And this divide is not about being smarter. It's about paying attention to the right layer of reality. The information gap becomes a wealth gap because institutions study mechanics while most people study headlines. Institutions move first, not because they predict better, but because they monitor the constraints that force others to move. Silver's message is not hidden in rumors. It's hidden in the structure, in the difference between eligible and registered, in the way margin converts volatility into liquidation, in the way giant stockpiles can exist while deliverable float still matters. So the question isn't whether silver can be volatile. We just watch that. The question is whether the next major move is driven by fundamentals, or by the last forced seller finishing their exit. This is signal before headlines, where we decode what matters before it's mainstream. If this connected dots you hadn't connected before, you know what to do. And whatever happens next, remember the lesson silver teaches over and over. The market doesn't just move on news. It moves on mechanics. And when mechanics change, price can fall into darkness even while the underlying story is still there, waiting.